What's happening, everyone? John A.G. here, and I need to share something that's going to shake up how you think about your precious metals if we're witnessing a monetary breakdown and all signs point in that direction. Then asking when should I cash out my gold and silver might be completely backwards. Picture this. You're on a sinking vessel, water's rushing in, and you're debating whether to sell your life raft. That's essentially what's happening right now. Before we go further, quick request. Most viewers aren't hitting that subscribe button. If this content helps you, please subscribe and write John AG below. Lets me know you're following along. Let's get started. Because we just watched gold surge back toward 4,800, while silver danced around that 95 to 99 zone. I know what's going through your head right now. That little voice whispering, this has to be the peak. Time to cash out, lock in these gains, don't want to watch this rally disappear. Here's the thing. That voice makes perfect sense. It's been programmed by decades of traditional thinking, decades of charts measured in weakening currencies, decades of advice from people who assume the current system lasts forever. But what if I told you something that changes everything? What if the currency you're measuring against is the very thing that's breaking down? What if success isn't converting back to paper, but preserving real wealth through the transition and exchanging it when the math works in your favor? That's exactly what we're exploring today, piece by piece. We'll examine what a top-tier financial strategist recently revealed, admitting what insiders have known quietly. We'll decode what bond market chaos is really telling us. And we'll map out the actual exit strategy if traditional currency isn't the target. Plus, I'll hand you a clear, practical system so you're not flying blind when decisions matter most. One quick note, check the description for bonus resources, including our exclusive WhatsApp updates and membership options for deeper insights. The financial establishment loves wrapping harsh realities in soft language. They won't say the system is cracking. They say market adjustment. They won't say unpayable debts. They say fiscal recalibration. They won't say currency collapse. They say portfolio reallocation. But occasionally, someone with real influence drops the pretense and speaks plainly. That happened this week. A legendary hedge fund billionaire, globally recognized, sat in a major international forum and essentially declared, the monetary foundation is crumbling, not a minor hiccup, not temporary turbulence, the foundation, the framework, the trust structure itself. When figures like this speak this bluntly, pay attention, because this isn't speculation, it's intelligence. I'm not suggesting hero worship. The messenger doesn't matter, and the message does, and the message is clear. Central banking behavior is shifting, capital flows are changing direction, and yesterday's safe assets are being questioned by the very institutions that once promoted them. Critical point coming up. Listen carefully. Fiat money comes into existence as debt. Every dollar. Euro. Pound-born carries an obligation. Somewhere in the system. Gold carries no such burden. Silver carries no such burden. No hidden promises waiting to fail. No institutions that can collapse and destroy your holdings. This is why stressed systems drive people toward tangible assets, not more promises. And it's not just individual investors making this move. Institutions are shifting. Central banks are repositioning. Smart money with superior information and timing is already moving. Given this reality, why would anyone abandon their financial lifeboat while the ship continues taking on water? I anticipate your response. Everything has value. Surely there's a price where selling makes sense. Here's where conventional thinking fails, for those still anchored to traditional currencies. My approach isn't selling precious metals for more paper. It's exchanging precious metals for productive assets when valuations become historically attractive. This isn't word games. It's strategy. Selling for fiat assumes fiat represents the destination. But if monetary structures are dissolving, fiat isn't the endpoint. It's either a temporary bridge or, more likely, a trap. Consider this perspective. Real wealth isn't measured by currency units in your account. It's measured by tangible assets you control without institutional permission. Property, businesses, productive equipment, inventory, rental income, agricultural land, energy systems, valuable skills, even a simple paid-off home. The transition from metals to these assets isn't about chart timing or peak calling. It's about monitoring relationships and market behavior. Here's a simple comparison that holds true. We're aboard a financial Titanic. Most passengers are still enjoying the entertainment because the show continues. They're still placing bets because the casino remains open. They're still watching market tickers because the displays keep updating. But some of us feel the deck shifting. We notice water in places it shouldn't be. We see crew members exchanging worried glances. Precious metals are your emergency vessels. Gold is the premium option. Fewer can access it, but it offers maximum value density and portability. Silver is the accessible alternative, heavier and bulkier, but within reach for more people, with practical money history that matters when systems fail. Here's the crucial insight. Knowing the ship is compromised, you wouldn't trade away your survival gear for entertainment tokens. So when do you make the exchange? When that survival gear can secure something superior to mere safety, when it provides genuine control, stability, and long-term productive capacity. This brings us to my practical decision framework. I apply 3 evaluation criteria. Criterion 1, system health indicators. When bond markets show distress, currencies face devaluation, and central banks stockpile gold, the warning lights are flashing. This isn't the moment to reduce protection. This is when you question any profit-taking impulses. The classic error during monetary transitions is trading real money for paper, right before paper valuations reset. Criterion 2, ratio analysis. Rather than asking if gold prices are high, ask what gold purchases. How many gold ounces for a local home? Silver ounces for reliable transportation? Gold ounces for quality income-producing assets? When these relationships hit historical extremes, meaning real assets become cheap relative to precious metals, that's your trading opportunity. The ironic part, most people do exactly the opposite. They purchase real estate when it's expensive in gold terms because the paper price appears reasonable. You won't make that mistake, not after hearing this. Criterion 3, personal circumstances. This unglamorous factor matters most. Your actual situation, emergency liquidity needs, family protection requirements, cash flowing business opportunities. Yes, these might justify partial exchanges. The objective isn't clutching perfect coins while missing life-changing opportunities. The objective is surviving and prospering through the transition. Now let's connect this to current market signals, because theory means nothing without application. Bond markets supposedly represent the boring, stable corner of finance. They should move predictably. When bonds start behaving like volatile stocks, that's a red alert. We've witnessed long-term government securities in major economies get hammered, then bounce slightly. Some call this stabilization. Traders recognize it as a dead cat bounce, temporary relief before the next decline wave. The mathematics are unforgiving. Massive debt loads plus rising rates equal impossible servicing costs. What do authorities do? What they always do? Cap rates, create money, or change rules. All 3 scenarios favor tangible assets long-term, despite short-term volatility. Add genuine inflation, not the sanitized official version. UK consumer price data just ticked higher again. Even accepting government numbers, the reality is stark. Bank deposits lose purchasing power. While most interest rates fail to compensate after taxes and real costs, this represents invisible taxation. Taxation without voting. Taxation that penalizes savers while rewarding borrowers. Once you grasp this dynamic, precious metals stop looking like investments. They start looking like preserved time, preserved labor, preserved purchasing power, ready for redemption when opportunities emerge. Let me address the trading mentality, because some of you are thinking, what about speculation? Futures, options, market timing? Sure, speculation has its place, but during monetary restructuring, speculation destroys people. Paper markets can swing wildly. Prices can crash. Headlines can terrify. Commentators can ridicule. That's the plan. They want you selling lifeboats because charts turned red temporarily. For real protection, divide your holdings mentally. Compartment 1, core security, untouchable, except for major life improvements or generational assets. Compartment 2, tactical portion, where skilled traders might take profits, rebalance, or trade around moves, but never risk core holdings for tactical gains. The macro investor's comment becomes even more significant here. When someone at that level reveals central banks are reducing fiat and debt exposure, you should ask what they're accumulating instead. Years of data show the answer. Gold. Not because it's fashionable, because it's the asset without counterparty risk, used for final settlement across empires, wars, and collapses. If central banks are positioning this way, respect the flow direction. Now the psychological challenge, where most people stumble. Gold rises and they feel brilliant. Gold falls and they feel foolish. This emotional whipsaw reflects fiat thinking. Real money thinking measures positions in ounces, not paper prices. Paper prices reflect stressed system opinions. Ounces represent tangible reality. When people ask, John, when are you selling? I repeat, I'm not liquidating insurance because premiums increased. I'm maintaining coverage until the world offers exchanges too good to refuse. Let's make this concrete. Imagine a future where quality land trades for 1 gold ounce, where productive farmland prices in gold ounces, not constantly shifting monetary units, where construction costs recalibrate and real money holders can build while others beg for financing. In that environment, selling decisions aren't about price targets. They're about recognizing this ounce now secures a long-term value generator. I'm converting stored purchasing power into production. That's the real transition. That's the moment. And it likely unfolds gradually, in waves, which is why you don't exhaust your entire position. You trade in portions as opportunities become compelling. Quick aside, since people ask frequently, for silver success stories, there's a description link to another channel featuring real people and actual results, worth checking out. Subscribe there too if you appreciate that content. Back to the main theme. Another indicator deserves attention. So simple, most ignore it. The Dow to gold ratio. Divide stock index numbers by gold prices. Declining ratios mean gold gains ground against equities. Historically, major financial regime changes appear in this relationship. We've been testing significant psychological levels. Continued compression suggests crowds slowly rotating from financial assets toward hard money. Important because it previews future opportunities. If gold becomes dramatically stronger versus stocks, then eventually trading gold for productive companies or real businesses could be generational. But not today. Not while ships take water and authorities pretend normalcy. Careful here, there's an opposite trap too. Some hear this and think, never trade. That's not my message. Don't trade for weaker currency. Trade for stronger assets. Gold isn't the destination. It's the bridge to the destination. And the destination is autonomy, life control, time control, family stability. Silver deserves specific discussion, and because silver triggers the strongest emotions, silver moves faster, more volatile, humbles traders more. This volatility explains silver's transition power. When silver moves, it can shock the public. Suddenly, the affordable lifeboat becomes scarce. Question for you. When silver captures attention again, will average people buy easily at any price, or will they arrive late, find delays, premiums, empty shelves, then blame everyone? That's why you position before euphoria, not during. I promise specifics. So 2 questions for the comments. First, thinking about your metals. Do you focus on price targets or purchasing power? Tell me your current mindset. Second, if monetary order truly shifts, what real asset would you target first for trading metals? Land, business, property, equipment, something else? Show me what this community values. And while commenting, share any financial success, large or small, debt elimination, emergency fund building, smart decisions. Your experience might inspire someone more than you realize. Returning to the core theme, this isn't about rising gold prices. It's about declining paper credibility. When credibility falls and people demand higher compensation, better returns, or they exit entirely, that's financial warfare. Not military conflict, capital conflict, not explosive weapons, flow weapons. When flows reverse, markets surprise everyone. Trying to time gold peaks while the world renegotiates trust, you're playing the wrong game. Better to hold trust-independent assets and wait for the world to offer genuine value. Practical checklist time. Do this. Maintain accessible physical metal positions. Don't leverage against them. Don't borrow against them for speculation. Do this. Monitor key ratios monthly. Housing to gold, stocks to gold, land to gold, energy to gold, whatever matters in your world. Avoid this. Daily price obsession like slot machine gambling. Do this. Plan acquisition targets and trading ratios. Avoid this. Waiting for news confirmation. News always lags. Description reminder. Bonus links include premium WhatsApp access and membership options. For deeper analysis, member-exclusive videos with separate research teams, going much deeper than public content. Consider premium membership for that additional layer. Where does this leave us today? In a world where precious metals prioritize protection over speculation, they represent votes against currency debasement. They offer exits from promise-based systems. Treating them this way reduces likelihood of doing what systems want, panic selling protection during manufactured crises. Final insight, because most still don't understand. Monetary system failures aren't linear. They occur in phases. Confidence erodes quietly first, then markets signal strangely, bond volatility, currency devaluation, sudden central bank policy shifts, Authorities respond with solutions, creating new distortions. Then almost suddenly, public awareness shifts. The question isn't whether this moment arrived, but whether you're positioned before it becomes obvious. Will I sell gold and silver? Not for paper. I'm holding, monitoring ratios, preparing to exchange for real assets when opportunities become historical. Want more content on specific ratios to watch, trading timing considerations, and situation-appropriate assets? Let me know in comments. I'll customize future videos to your actual needs. If this helped, subscribe. Seriously, it matters more than you know. Drop John AG below. Tells algorithms this deserves promotion. Tells me your core community. Take care. Watch out for each other. See you next time.